Good morning and welcome to a very special Breakaway Funding presentation, and what a celebration it is. After nearly 3 long years since the Jumpstart Business Startup Act, or JOBS Act of 2012, was signed into law by the President, the Securities and Exchange Commission last Friday, October 30th, 2015, adopted rules to permit companies to offer and sell securities through crowdfunding. A happy Halloween treat to us all. The Commission also voted to propose amendments to existing Securities Act rules to facilitate intrastate and regional securities offerings. These new rules and proposed amendments are designed to assist smaller companies with access to capital while providing investors additional protection. Our brief discussion this morning will review these and other provisions of the JOBS Act through the lens of companies choosing to raise capital through crowdfunding, also known as issuers, as well as investors, and then those who might be considering operating a funding portal. This is Kim Kaselionis, founder and managing partner of Breakaway Funding, and I am delighted to share this good news with you today. As many of you know, Breakaway Funding was founded to help solve a two-pronged problem I encountered during my tenure as CEO of Circle Bank. First, lack of access to capital for small to medium-sized businesses, and community banks struggle to lend. The solution, a fully integrated crowdfunding platform, which would serve to match investors with businesses requiring capital to strengthen their balance sheets and position those companies for further funding by traditional banks and credit unions. Today's discussion is key in helping to bridge this funding gap. Now, no presentation would be complete without disclaimers. This is ours. This presentation is for informational purposes only. Breakaway Funding is not a registered investment firm or a broker-dealer, and I am not an attorney. This is not a solicitation for the purpose or sale of securities, etc., etc. And finally, we are talking about regulation. We have attempted to condense the new crowdfunding rules and other regulatory changes while providing you complete information. This is no small task, but we have done our best. To set the stage, under the Securities Act of 1933, any offer to sell securities must either be registered with the Securities and Exchange Commission or meet an exemption. Regulation D, or Reg D, is the provision through which most private capital is raised. Reg D contains 3 subparts, providing exemptions from the registration requirements, allowing companies to offer and sell their securities without having to register the securities with the SEC. These exemptions are Rules 504, 505, and 506. We refer to 504 and 506 in this presentation. Now, as you are aware, these rules favor the wealthy, meaning that investors must meet certain financial hurdles to qualify to invest in these private equity securities. The reality of it is only 8 to 10% of the population actually meet these thresholds, and only half of them actually are active in private equity investing. This leaves roughly 90% of the total investor population on the sidelines and out of reach to companies seeking capital investment. Compound these dismal statistics with the contraction in the capital markets during 2008 and continuing even today, and you have a landscape that is prime for change. That change? The JOBS Act of 2012. Now, the JOBS Act was enacted on April 5th, 2012. It represents the most significant deregulation in the Securities and Exchange law in nearly 80 years, and its purpose was to improve and provide greater access to capital for small business in order to stimulate the economy and to create jobs. There are 6 titles or provisions in total, all designed to expand which companies can raise capital, who can invest, and how those investors can be solicited. We'll run through each of them really briefly. Title I creates an on-ramp to the IPO market. It is an easier, softer way to the public markets by easing the regulatory burden and cost of conducting an IPO and being a reporting company for a new class of issuer known as an emerging growth company. Title II lifts the ban on general solicitation of securities being offered for sale. Historically, issuers or companies were restricted on how they could solicit their offerings. You had to know who you were marketing to and know if they were qualified to invest prior to solicitation. Effective September of 2013, private companies can now advertise their offerings in the newspapers, on billboard signs, and many are featured on the crowdfunding sites today. The caveat is that if you choose to use general solicitation via Title II, all of your investors must be accredited and you must be able to verify they are in fact accredited. Title II is not crowdfunding, despite the fact that it is being conducted online. These capital raises are being conducted online. Rather, it is a change in the Securities Exemption Rule 506 under Regulation D. Title II is now referred to as 506C. We will skip Title III and go on to Title IV. Title IV is the Small Company Capital Formation Rule, which enables companies to raise up to $50 million every 12 months. Existing Regulation A, another exemption from registration applicable to small public offerings of securities similar to Reg D, permits the sale of securities to both accredited and non-accredited investors, so long as the issuer files a mini registration statement with the Securities and Exchange Commission and complies with relevant state law requirements in each state where the funds are being solicited. This provision is for capital raises that do not exceed $5 million in any 12-month period. Title IV is the new and improved Reg A, now referred to as Reg A+. Reg A+ increases the amount of capital small companies can raise from the public market from $5 million to $50 million and increases the number of shareholders from 500 to 2,000 before having to become a SEC reporting company. There are two tranches or two tiers under Title IV Reg A+, each having their own characteristics relative to how much capital can be raised, your financial reporting requirements, as well as whether or not you have to register in each state in which you plan to offer your securities. This change is very meaningful to the real estate industry, developers and investors alike. Titles 5 and 6 are closely related in that they both increase thresholds for registration or deregistration as a public reporting company. As you can imagine, being a publicly reporting company is very costly. These provisions are applicable to all companies in general as well as banks and bank holding companies. So now companies that have 2,000 shareholders or less can deregister and therefore forego the annual SEC reporting requirements. So what is crowdfunding and what is Title III? Crowdfunding is a method of raising capital through the internet, but it has generally not been used to offer and sell securities until now. As we mentioned earlier, the Jobs Act was created to assist small businesses in accessing growth capital to create jobs during the financial recession. It includes an exemption via Title III to permit securities-based crowdfunding and establishes a foundation for a regulatory structure for these transactions. It also creates a new entity, a funding portal, and allows these internet-based platforms or intermediaries to facilitate the offer and sale of securities without having to register with the SEC as broker-dealers. For companies choosing to raise capital via securities-based crowdfunding in Title III, which we believe is an extraordinary opportunity to convert your social capital, your network of relationships, into the financial capital you need to launch or expand your company, you will have an opportunity to raise up to $1 million every 12 months from an unlimited number of non-accredited investors. So the 92 or 90% of the members in your communities, irrespective of where they may reside. Certain companies are not eligible. Your investors will not be able to sell their holdings, their stock or notes, for 1 year. This is a common provision in the existing string of Reg B exemptions. Transactions must take place on one platform. Many companies today raising capital under existing securities exemption straddle different platforms to try and expand their reach of investors. This will not be permitted under Title III offerings. And finally, the transactions must be done in an orderly fashion through one of these two options, either SEC-registered intermediary, a funding portal, which we'll talk about in a few minutes, or through a crowdfunding platform that is operated by a broker-dealer. For the privilege of being able to invite your community to become part of your shareholder base, you will have to be transparent about your offering and your company's financial performance, including information relative to the offering securities price, method for determining the price, the target offering, the deadline, and whether or not the company will accept investments in excess of the target offering amount. There will need to be a discussion about the financial condition. You will be required to file financial statements and provide your investors with financial statements. Some will have to have reviewed financial statements, CPA reviewed or audited. You will need to give a business description and a use of proceeds outline. Information about officers, directors, and owners of 20% or more will have to be highlighted, as will certain other related party transactions. And finally, you will be required to file annual reports with the SEC. If you are considering raising capital under Title III rules, we encourage you to begin preparing today for two reasons. One, it takes time to prepare for the raise. As you can see, you will be required to provide your prospective investors a considerable amount of information from which they can make an informed investment decision. And secondly, as we will soon see, non-accredited investors are going to be limited as to how much investing they can do every 12 months, and you want to reach them before your competition does. For investors, those of you who've been waiting for an opportunity to invest in companies in your local community or companies whose mission is aligned with your values, but you do not meet the accredited investor definition, the new rules provide the parameters under which you may participate. If your income and net worth is less than $100,000, this excludes the equity in your home, you will be able to invest the greater of $2,000 or 5% of your income. So that's somewhere between $2,000 and $5,000 in total, in the aggregate, through all crowdfunding investment opportunities that is securities-based in a 12-month period. If your income or net worth is greater or equal to $100,000, your limit is increased to 10% of that number, so about $10,000 per year. So under either scenario, you are going to be capped in the total amount of investment that you may make through all crowdfunding platforms, all crowdfunding investments every 12 months. If you are considering becoming a funding intermediary or a funding portal to help facilitate the flow of capital under these new rules, here's what is in store for you. I won't go into too great a detail about these requirements. Suffice it to say, the SEC has done a good job of providing the specifics. But you will be required to register with the SEC, become a member of FINRA, provide investor education, make certain disclosures available, provide communication channels to permit discussion about offerings, accept investor commitments only after the investor opens an account. And there's more. Have a reasonable basis that investor complies with the investor limitations and provide investors notices and confirmation prior to the close, and comply with the maintenance and transmission funds requirements. Additionally, there are some activities that are prohibited by funding portals. One, you must help protect against fraud by limiting access to your platform to companies that you have a reasonable basis for believing that the potential for fraud or other investor protections might be at risk. You will not be allowed to engage in any self-dealings, meaning that funding portal owners cannot have a financial interest in the company offering or selling securities on their platform unless that intermediary receives financial interest as compensation for services, and then again, these are going to be subject to certain conditions. You cannot compensate any person for providing you with personally identifiable information of any investor or potential investor. And you are prohibited from offering investment advice or making recommendations. Deciding whether or not to become a funding portal or in which flavor you choose is a personal and business decision. Please consult your legal professional for advice and counsel to discuss these rules in more detail. In the beginning, we stated that in addition to adopting final rules to permit companies to offer and sell securities through crowdfunding, the SEC was also considering other amendments to existing Securities Act rules to facilitate intrastate and regional securities offerings, also designed to assist smaller companies with access to capital while providing investors additional protection. These are threefold. First, they intend to modernize the Act Rule 147 for intrastate offerings to further facilitate capital formation, including through intrastate crowdfunding provisions. Secondly, they intend to amend Securities Act Rule 504, which we identified earlier, to increase the aggregate amount of money raised from $1 million to $5 million every 12 months, and finally, to apply bad actor disqualification. This is an additional investor protection, which basically means that anyone who has previously been convicted of securities felonies will not be able to participate. The first modernizing rule, SEC, does a couple of things. It will permit companies to raise money from investors within their state without concurrently registering at the federal level. It will eliminate the restriction on offers while continuing to require that sales only be made to investors in the issuer state. So if I'm a California corporation and I choose to use one of these exemptions, I will only be allowed to accept investors who live in California. It will also refine intrastate offering definitions and issuer eligibility requirements. And finally, it will limit but increase the level of offering registered in intrastate or understate registration to no more than $5 million every 12 months, which is a nice increase from the current $1 million. And here is one of the reasons why these proposed amendments might be under consideration. As of August of 2015, 25 states have already enacted their own intrastate crowdfunding securities exemptions. I think it's time for the SEC to catch up. Proposed amendments to Rule 504 just increases the amount that you're able to raise from $1 million to $5 million every 12 months. The SEC is seeking public comment on these two proposed amendments for the next 60 days. Both of these planned amendments are great for small businesses because raising capital takes time and requires resources. Increasing the limit and the amount of money that capital can be raised helps to drive down the cost of raising capital and make access more economically feasible. So when are these rules going to be effective? 180 days after they are published in the Federal Register. The SEC is currently seeking public comment for the next 60 days. So we're looking at sometime in mid-2016. For funding portals, however, funding portals can submit their registration paperwork as early as January 29, 2016. To help drive home the importance of these new and proposed rules, specifically as they relate to equity crowdfunding, let's take a look at the potential impact to various members of our local economy. For small businesses, equity crowdfunding creates a new opportunity for capital and liquidity at every stage in their growth cycle. It allows businesses access to non-accredited investors. There is a greater geographic reach, and equity crowdfunding can be used in conjunction with traditional bank financing, the reason why Breakaway Funding was created. It's an efficient and expeditious marketplace, and certainly the market is growing. Where does crowdfunding fit on the funding continuum? Well, historically, once ideas have met minimum viability tests by the crowder community, an equity or debt-based crowdfunding campaign might be appropriate. It will provide increased capital for growth and vetted interest of supporters, but in reality, anywhere along this continuum from seed capital to expansion capital. What's in it for investors? Well, everyone can now be an angel investor. So crowdfunding is available to large and small investors alike. It provides an opportunity for portfolio diversification and a potential to earn competitive returns while boosting the local economy. Many of you have heard of the Kickstarter campaign for Oculus. 9,500 investors raised about a total of $2.4 million. In return for their contribution, those investors got the glasses. Problem was, then Oculus went on to sell to Facebook for $2 billion. None of those 9,500 investors got to participate in the appreciation and the value that was created by their original capital dollars. So here's an opportunity for early stage investors to earn competitive returns. There's also an opportunity for investor engagement. People will be able to get the wisdom of the crowd. That one of the rules that we just discussed requires funding portals to facilitate this kind of communication and conversation. One thing to be clear and to remember, however, that irrespective of all of the benefits of crowdfunding brings to investors, it does not mean that there is no risk here. Private equity investing, particularly in early stage, is risky. So please make sure that you do your due diligence and you ask questions and get advice if you need it before investing. And finally, how does crowdfunding benefit the economy? Well, one of the preambles to the Jobs Act was to access the $17 trillion in cash in American retirement accounts. Just think, if every American invested 1% of that $17 trillion, this would equate to about $170 billion in new capital for small business. That's a lot of innovation. And think of the multiplier effect that we could achieve when community banks and credit unions leverage equity investment to lend more money. This is a decentralization of capital. It promotes economic recovery through entrepreneurship, innovation, and employment, builds healthier and more vibrant communities, does not require U.S. government spending, and finally, it creates jobs. We hope you have enjoyed this presentation on the Jobs Act and Title III securities-based crowdfunding. Please join us for any or all of the upcoming webinars. On November 11th at 10 a.m. Pacific time, I will be talking about crowdfunding for banks. This is being offered by Compliance Online, and there is a registration fee. We will be back November the 19th with Coy Deng and Justin Santa Rosa of Horgan, Rosen, Beckman, and Cora, talking about getting your act together. Just in time for Title III to become effective, here is the legal prep work that needs to get done. Come and learn about these considerations. And then on December 9th, again being offered through Compliance Online, financial statements, reporting, and modeling. If you have any questions about this presentation, raising capital, or investing in private offerings at Breakaway Funding, we would love to hear from you. We believe that working together, we can make a difference. Thank you for joining us this morning. We appreciate your time, and we look forward to seeing you in the near future.